If you remain financially broke, banks will love you. But if you have a sum of money sitting in your bank account, you can be sure they will hate you. Put it to the test, and you will see I am telling the truth. Have you ever noticed that your bank becomes extremely attentive when you are out of money? Like that personal loan offer that appears as a notification on the app exactly when your account is running dry, or that credit card limit increase that shows up like magic after you blew through the month's budget. But when you manage to save something, when you finally accumulate $17,000 in the account, something curious happens. They go completely silent. No calls, no special offers. The most they give you is a basic savings account yielding 0.01% per year. That is, right, practically nothing. Have you ever stopped to think about why? Here is the explanation. This does not happen by accident. It is not an oversight, and it is not a system failure. It is exactly how the banking system was designed to operate and enrich itself through its customers. And today, I am going to explain precisely why a traditional bank would infinitely prefer that you owe $5,000 than have $17,000 saved. And when you understand this arithmetic, when you truly absorb how this mechanism turns, your perception of banks will change forever. Let us start from the scenario most Americans know and live with daily. You work the whole month, receive your paycheck, and the next day an enormous slice has already evaporated in automatic debits. Rent, car insurance, electricity, health plan, phone. You have $1,800 left to get through the month. You buy groceries, fill up the car, pay for transportation, and when the 15th arrives, the money has vanished. Simply nothing left. Then you check the calendar and think there are still 2 weeks until the next paycheck. And it is precisely at that moment that your bank becomes your best companion. A notification appears on your phone. Congratulations, you have $4,000 of pre-approved credit on a personal loan. It is almost like they guessed, right? And the truth is, they really do know. They have all your data. They know when you get paid, how much you spend, what day of the month your account starts running dry, and they calculate with precision when you will be vulnerable enough to accept a credit offer. Understand that this is a business model built on the predictability of your financial squeeze. So you borrow $3,000 at a rate of 12% per year. It seems reasonable compared to the credit card, which charges 28%. On a 36 installment loan, you pay around $105 per month. You calculate and conclude it fits in the budget, and it really does fit. The problem starts the following month. Now you have $105 fewer dollars available every month. So when the 15th comes around, you are not just facing that natural gap between what comes in and what goes out. You are facing that gap plus the loan installment. Then the next step of the cycle happens. You exceed your account balance by $150 for 3 days. This is what the bank calls overdraft protection. It sounds like a friendly name. It sounds like they are protecting you. In reality, the bank charges $35 for each transaction that goes over the limit. If 3 purchases go through on the same day, that is $105 in fees in a single day. You paid $105 for the privilege of using $150 that were not yours for 72 hours. If you stop to calculate what that represents in percentage terms, it is an annualized rate exceeding 600%. There is no investment on the planet that offers that kind of return. But the bank earns that return on your money every time your account goes negative. Now, let us look at the mechanism from the inside. The bank lent you $3,000 at 12% per year. Where did that money come from? From someone like Mrs. Margaret, who has $40,000 in a certificate of deposit earning 0.4% per year. The bank takes her money, lends it to you at 12%, and pays her 0.4%. The difference between what the bank pays out to acquire the money and what it charges to lend it is where the profit lives. In this example, the bank earns 30 times more than it pays the person who deposited the money. And that is with a certificate of deposit, which is already a reasonably decent product. In the traditional savings account, where major banks pay 0.01% per year, the disproportion is even more grotesque. The bank lends that same money at 12, 20, 28%, while paying the depositor practically nothing. It is such a profitable business that the largest American banks record quarterly profits in the billions. This happens every 90 days. And the central mechanism that fuels this profit machine is simple to understand. It only works if you are on the fragile side of the equation. The bank needs you to need it. It needs you to live permanently in this state of scarcity, where accepting a loan at 12% seems like a reasonable way out, because the alternative is not paying rent, not covering a medical emergency, or destroying your credit score. And it is precisely this dependency that keeps the mechanism turning. Another piece of this machine is the revolving credit card balance. This is perhaps the most efficient profit instrument a bank possesses. It works like this. Suppose you accumulate a $2,000 bill on the card. On the due date, due to some unforeseen circumstance, you can only pay $1,500. $500 remain unpaid. Those $500 begin accumulating interest at the average card rate, which at major American banks runs around 28% per year, which works out to approximately 2.3% per month. Let me translate that into concrete numbers. $500 on a revolving card balance becomes $572 in 3 months if you pay nothing. Seems small? Extend the time frame. In 12 months, those original $500 have become $659. You paid $159 in interest on a $500 debt, and the bank did not have to do a single thing to earn that money. It simply charged interest on a balance you could not pay off. Now multiply that by millions of customers doing the same thing every month. You can understand where the billions in quarterly profit come from. And there is a detail that almost no one notices about how the credit card really works behind the curtain. When a store accepts your card, it does not receive the full purchase amount. The bank takes a cut that ranges between 2 and 3% of each transaction. It is called the interchange fee. On a $1,000 purchase, the store hands over between $20 and $30 to the bank just for the act of processing the payment. And guess who absorbs that cost in the end? You. Because the merchant has already built that fee into the price of the product. When a store offers a discount for cash or debit payment, that is the reason. It is giving back to you the fee it will not have to pay the bank. The entire system is architected to keep you dependent. Think about it. If you never have a reserve, you will need the bank every time something goes out of your control financially. Car broke down? They offer a personal loan. Medical emergency? They offer the credit card. Lost your job? Take an overdraft. And each one of those situations pushes you a little further down, because you are not just solving the immediate problem. You are generating a debt that will follow you for the next months or even years. And this affects your mind in ways you do not always notice. There are people who live in a permanent state of financial anxiety, and that is very harmful. They wake up in the middle of the night thinking about bills. They avoid opening the banking app. They feel a tightening in their chest every time they swipe the card without knowing if it will be approved. And the worst of all is that this starts to feel normal. You begin to believe that financial life is just like this, that everyone lives this way, that there is no alternative. This mindset is the foundation that sustains the entire bank profit structure. As long as you believe that living in debt is natural, the bank keeps profiting from your fragility. But there is a turning point, and that turning point happens when you finally cross the threshold of $17,000 saved. I know what is going through your mind right now. I can barely save $500. How am I going to reach 17,000? I understand. When you are buried in debt, when every month is $1 per month net, they live in the same city, face similar expenses, have the same routine, but there is one single detail that completely separates the financial future of the two. Client A does not have a single cent saved. Client B has $17,000 in reserve. February arrives and Client A's car develops a serious mechanical problem. The repair costs $3,500 and he cannot pay it right now. The only alternative is to put it on the credit card and pay the minimum installment. At a rate of 28% per year, if he takes 18 months to pay it off, the $3,500 repair ends up costing around $4,400. That is $900 extra he paid simply because he did not have a reserve at the moment the problem appeared. Client B faces the same situation, same car, same defect, same $3,500 estimate, but he has a choice. He withdraws from the reserve, pays in cash, asks for a discount, and closes the service for $3,100. He saved $400 on the spot. In the following months, he replenishes the reserve at his own pace. The situation does not snowball. He resolves it, closes the matter, and moves on with his life. This is the practical difference between having a reserve and not having one. When the unexpected appears, and it always does, the person without a reserve pays more for the same problem and still carries the weight of the debt for the months that follow. Now advance 18 months on the timeline. Client A is still carrying the card balance. And it was not just the car. During that interval, other unexpected expenses arose. He overdrew twice, accumulated a revolving card balance once, and now totals $6,000 in debt spread across a card and a loan. Between installments and interest, he pays out around $600 every month. Of the $4,500 he receives, $600 evaporate before they even reach his pocket. He survives on $3,900. Client B has replenished the reserve, still has his $17,000 saved, and when an unexpected expense arises, he uses the reserve, resolves the matter, and then restores the amount. He pays no interest to any institution. Of the $4,500 he receives, $4,500 remain with him. In the end, the disparity between the two is enormous. $600 per month represents $7,200 per year thrown away in interest and fees solely because one had a reserve and the other did not, and that calculation is conservative. In most real cases, the difference is even greater, because the person without a reserve tends to make increasingly worse financial decisions as the pressure mounts. But the story does not end there. There is an even more revealing detail. Those $17,000 belonging to Client B are not sitting idle. They are not forgotten in a drawer. They are earning returns. If that money were in a high-yield account paying around 4.5% per year today, it would generate approximately $94 per month in income, money coming in without him having to lift a finger. Meanwhile, Client A, buried in debt, hands $600 per month to the bank in interest and fees. Client A loses $600, Client B gains $94. The real difference between the two is not $600, it is $694 per month, more than $8,300 per year. These numbers reveal something that most people never calculate. The cost of not having a reserve is not limited to the interest you pay. It also includes the returns you fail to earn. These are two forces operating in opposite directions at the same time, and the gap between them widens month after month. Let me show you what this looks like over 5 years. Client A, if he stays trapped in this cycle of debt and interest, will have handed somewhere between $35,000 and $45,000 to banks and card companies, just in interest and fees. And the most disturbing part is that even after paying all of that, he will probably still owe something. Client B, meanwhile, keeping the reserve intact and investing the monthly surplus, can comfortably accumulate somewhere between $80,000 and $110,000 in that period. The distance between the two starts at $17,000 and surpasses $130,000 in just 5 years, all because one chose to be on the right side of the interest equation. And here the situation gets truly interesting. The bank loves Client A. He is the ideal customer. He is always in need, always requesting credit, always paying interest. He is predictable, he is fragile, and he is extremely profitable. Client B, on the other hand, the bank despises. The reason is simple. He generates no profit. He does not request loans, does not accumulate revolving balances, does not fall into overdraft, pays everything in cash, asks for discounts, and even invests in products that yield more than the traditional savings account, often at competing institutions. When you have $17,000 saved, you stop being a vulnerable customer and transform into a demanding customer. You do not accept just any proposal. You start comparing rates, you start analyzing your statement and asking, why would I leave my money earning 0.01% per year in a big bank savings account when I can put it in a high yield account paying 4.5% with the same security? You start to notice that the certificate of deposit the manager offers you with exaggerated enthusiasm yields less than far simpler and more accessible options available at other institutions. And something else changes too. Your relationship with consumption. When you have no reserve, every unexpected expense becomes a desperate situation. You act on impulse, accept any terms, agree to any price. When you have $17,000 saved, you take a breath, analyze the situation, and ask yourself, do I really need this right now? Can I wait? Is there a cheaper way to solve this? That is genuine power of choice. It is the difference between buying out of desperation and buying by decision, between accepting the first credit they push at you and not needing any credit at all, between living in financial squeeze and having real control over your money. The psychology of financial decision-making changes completely when there is a financial reserve behind you. The person without a reserve makes decisions from fear. The person with a reserve makes decisions from logic. And the long-term consequences of those two approaches are radically different. Now, the question that makes us reflect, how do you get off the fragile side of this equation and reach the $17,000 reserve? Because if you are in the negative right now, if you carry debt, if you can barely close out the month, that amount seems impossible. But let us go step by step. First step, stop the bleeding. As long as you have expensive debt, as long as interest is consuming your paycheck every month, you will not be able to accumulate anything. The initial priority is not investing and not saving. The priority right now is eliminating the debts. If you are carrying a revolving credit card balance, that is the maximum urgency. Negotiate with the card company, request an installment plan with a lower rate, or, if necessary, take out a personal loan at 12% to pay off the card charging 28%. It seems contradictory to take on debt to pay off other debt, but from a mathematical standpoint, it makes sense when you are replacing a debt at 28% with one at 12%. You are cutting the interest in half. It is the same logic as putting out the bigger fire first. If you fall into overdraft frequently, you need to build a mini reserve, even if it is just $300 in a separate account, exclusively to avoid overdraft fees. Because every time a transaction exceeds the balance, the bank charges $35. If it happens 3 times in a month, that is $105 in fees that simply would not exist if there were a minimum cushion in the account. Second step, build the reserve gradually. It does not need to be $17,000 all at once. Start with $500, then $1,000, then $2,500, then $5,000. Each one of those values already changes your game significantly. With $500 set aside, you no longer need the card for a small emergency. With $5,000, you handle most unexpected expenses without depending on any bank. And here is something that almost no one mentions. You do not need to set everything aside all at once. You can go slowly, but you need to save before you spend. Pay yourself first. That is the golden rule. When the paycheck hits the account, transfer $100, $200, or $300 to a separate account, preferably at another institution. And forget that money exists. Live on what remains. And do not worry, because your brain always adapts to the available amount. If you receive $4,500 and set aside $200, within a few weeks, you will be living on $4,300 without noticing the difference. The habit of saving precedes the amount saved, Start small and the amount grows on its own over time. Third step, where to put this reserve. There are digital high-yield accounts paying between 4 and 5% per year with immediate liquidity and no fees. Institutions such as digital banks and online financial platforms offer these options. They are infinitely superior to the traditional savings account at major banks, which pays practically nothing. The difference is enormous over 12 months. $17,000 in a conventional savings account earns about $2.50 per year. The same $17,000 in a high-yield account generates more than $1,100 over the same period. It is the same money, the same risk, the same liquidity, and an absurd difference in the result. Fourth step, learn to put money to work for you. When you have a reserve, you can negotiate cash discounts. On a $2,000 purchase, a 10% discount puts $200 in your pocket. That return is immediate and greater than what your money would earn in months invested. You also learn to wait for the right moment. Seasonal promotions, clearance sales, end-of-season offers. Whoever has no reserve buys when the problem appears, regardless of price. Whoever has a reserve buys when the price is good, regardless of timing. Accumulated over a year, that difference in behavior represents thousands of dollars saved. And here, the mindset shift happens. You stop paying interest and start receiving interest. You move off the side of those who finance bank profits and join the side that captures part of those profits. You do not even need to declare war against the banking system. You just need to learn to play the same game they play. If you wish, you can even invest in the shares of those same banks that record billions in quarterly profit. The largest American bank, for example, delivered an average return close to 19% per year over the last decade. Let me put that in numbers to make it tangible. If someone had invested $400 per month in those shares since 2016, they would have something around $150,000 today. And if that same pace continued for another 10 years with similar returns, the wealth would surpass $600,000. One of the most successful investors in history summed it up in a phrase worth more than any finance course. Whoever understands interest receives it. Whoever does not understand it pays it. Fifth step, defend this reserve tooth and nail. An emergency reserve is not for vacations, not for replacing your phone, not for taking advantage of a tempting sale. It is for real emergencies. Health problems, accidents, job loss, urgent repairs. If you start using it for any temptation, it will disappear precisely when you need it most. And rebuilding a reserve after zeroing it out is much harder than building it the first time because the spending habit has already reinstated itself. And here is a truth that makes people uncomfortable, but that needs to be put on the table. Most people will never reach the $17,000 reserve, and the reason is mindset. Because they do not believe it is possible, because they think investing is a privilege of those who earn a lot, because they prefer to pay in 12 installments rather than save for 3 months and buy outright with a discount. Because they live on autopilot, spending everything that comes in without ever stopping to question whether there is a different path. But you do not have to follow the path that most people follow. You can be the exception. You can be the person who 2 years from now will look back and recognize this completely changed my financial life. You can be the person who does not panic when the car breaks down, who does not lose sleep over bills, who does not live as a hostage to any bank, and does not need a manager's approval to solve their own problems. Banks have built a system where your financial fragility is profitable. Every time you need them, every bit of interest you pay, every overdraft fee that hits, it finances their billions in quarterly profit. And they are not going to change this system. Why would they? It is operating perfectly in their interests. But you can change your position within this equation. You can stop being the customer who pays interest and become the customer who receives returns. You can stop being one more number in the debt statistics and become someone who manages their own financial life with autonomy. $17,000. This number is about what that figure represents. It represents autonomy. It represents security. It represents the moment where you leave the bank's game and start running your own financial game. And when you reach that point, when you open the app and see that positive balance, that reserve built month after month, dollar after dollar, you will understand why banks hate whoever has $17,000 saved. Because you stopped being fragile. And financial fragility is the most profitable product they sell. When you stop buying that product, they lose the most lucrative customer they have. In the end, financial freedom does not mean owning a fortune. It means not depending on anyone when life tightens, and that is priceless. If you made it this far, comment, $17,000 changes everything. When I read your comment, I will know you are persistent for staying until the end. So comment. Thank you for watching. Subscribe to the channel, like the video. It helps the channel grow enormously. Thank you once more. See you in the next video.